Hello, everybody. I'm going to give just a couple seconds here for people to join up. All right, I'm going to get going here. Hi, everybody. Thank you so much for joining us for the Charles Stanley webinar, all about the extremely important question of, will I have enough to retire? My name is Erica White, and I will be the host of this session today. So throughout the course of the next hour or so, I'm going to be joined by some of my fabulous and very knowledgeable colleagues to talk us through what we need to know when planning for retirement, a chapter of life that if you're tuned into this call, you're obviously thinking about, as you should be. It is very, very, very important stuff. For some of you, retirement might be in the near future, but for others, myself included, it might still be decades away. But either way, it's never too early or too late to be learning about this extremely crucial and often overlooked topic. Before I dive into the agenda today, I'm just going to do a little bit of housekeeping. But before I do that, I just want to share a little fact with you guys here. The number one source of stress for UK adults is, maybe unsurprisingly, money. So that's above family duties, work, health, or anything else, it's money. So facing into that, spending even just a little bit of time getting your finances organized and making an action plan for your money are all huge relievers of that stress. I'm sure that a lot of you have heard the famous phrase that knowledge is power. I love that saying. And that really truly is the case when it does come to your finances. So well done to each and every one of you. Give yourself a little pat on the back here for logging in today, for joining us here for what we're hoping will be a very informative, clear, and very engaging webinar. Okay, housekeeping time. As mentioned in our email communications, we just want to remind you that this session is best viewed on an actual computer or a laptop, not on a mobile or a tablet. So if you're currently tuning in from a tablet or from your phone, our recommendation is for you to switch to watching us from a laptop or a desktop computer instead, or you might not be able to read the slides that we have created for you, which kind of does defeat the purpose. We've worked very, very hard on these slides for you guys to be able to read and enjoy. Another reminder here, when you're looking at the screen right now, the slides with the text and those images that you see should be the largest box that you see. And if that's not the case, please do click on the top right-hand button that says view and then select speaker mode, which then should make sure that you can read and enjoy the slides with ease as the session does continue. So we've done our very best to create what we're hoping is a really informative and interesting webinar for you guys, and we do expect tons of questions throughout, and we are so looking forward to answering those. That's honestly one of the highlights of these sessions. But please do keep in mind that the experts you'll be hearing from today are not allowed to give specific individual financial advice. So if you're wanting to pop some questions into the chat box as they come up, and we absolutely do hope that you do that, please try to phrase your questions in kind of like broader terms, as opposed to asking like specific numerical questions or things about individual stocks or anything just like too nitty gritty on this forum, because unfortunately we're gonna have to skip anything that's too specific, which we absolutely do not want to be doing. We want the chance to answer as many questions as possible, given the time constraints, of course. Final thing I'll be saying here before we dive in is we're going to be sending out this recording and the corresponding slides alongside it in a follow-up email. So please do look out for that. We get a lot of questions about that. Some people find it helpful as well to have a pad of paper and a pen nearby, because we will be giving you guys quite a bit of information today. Okay, let's take a look at the agenda. Housekeeping over. We're going to start off by talking through the details of how much retirement actually costs. There is a range here, of course, but we've got you all covered. We're then going to be discussing saving pots, then diving into the complicated world of tax relief, the different types of pensions and sources of income in retirement. We're then going to be discussing the state pension, got a lot of great information about that, investing in retirement, and then finally, we're going to be opening the floor to a Q&A session and a review of some of the key dates with our experts. So this is your chance to ask our professionals anything that you have to ask them, and they are so looking forward to answering your questions today. Okay, it's time for me to introduce our very first expert. We've got Lisa Kaplan on deck here. Lisa is the One Step Financial Planning Director here at Charles Stanley. She's a chartered financial planner using technology to make it easier for people to move forward towards financial well-being. So what she does is she combines digital experience and financial planning knowledge gained over 13 years working in the personal finance space, and is the perfect person to guide us through this upcoming bit. Hi, Lisa.
Hi, Erica. Thank you. And hello,
yours.
Everybody. Thanks for joining. It's challenging planning for retirement. It's really a long way away. It's often over your horizon. So I'm going to talk about in sort of a bit of crystal ball gazing about savings pots and tax relief, and then Rob's going to talk about the investment strategy that goes with that. Laura, let's go. Next slide, please. Okay, so people often don't know the numbers to put next to their retirement. They don't know what it's going to cost. There has been some research, some excellent research done by the University of Loughborough, which is published by the Retirement Living Standards Organization, and they do this every year. And this is what they reckon a retirement would cost single people and couples. So the minimum sort of base level would be £13,000 for a single person, and then going up all the way for a couple together for a comfortable lifestyle. We're talking about £55,000 a year. I've got a little bit more detail in the next slide. I'm not going to go through everything because this, as Erica said, this is going to be sent out. But the minimum lifestyle is really all your meals covered, eating out maybe once a month, a UK-based holiday. The moderate is sort of one foreign holiday, eating out more often. And then sort of the comfortable is really you've got a lot of flexibility. In terms of the number of sort of what people experience is 3/4 of people meet at least the minimum income needed for that lifestyle. A half meet the moderate, and only a sixth get the comfortable lifestyle. And a bit chillingly for people sort of just starting out now, is these numbers assume that you own your home outright, that you don't have any mortgage or rental costs involved. Also, as well, it's sort of an average UK figure. If you're talking about the Southeast or London, you can add a couple of grand onto those numbers as well.
Quick question for you here, Lisa, if you don't mind me just hopping in. Question if these figures are pre-tax or are they after tax?
They're after tax. So this is the money that you have to spend. This is what it costs you.
And then what about thinking about inflation in the future? So like if for the 55K one, does that mean that 60K would be needed in 5 years kind of thing?
Yeah, I mean, this is in today's terms, but that number will go up with inflation. But hopefully, you'll have time to save, and your investments would grow. Of course, I have to say they could fall as well. So yeah, it's a future. It's in today's terms. It does not
Thank
take.
you. Okay, I'm gonna have to hide again now. Thank you.
Okay. Laura, can I have the next slide, please? Okay. So the question is, are you saving enough? And Eric talked about technology. Well, I'm going to be very low tech because I talk often with a tape measure to help you sort of get your head around it. It's a good exercise to do. So you start with your age as you are now, and I'm using the example of someone who's 30. And then you think, well, how much longer am I going to be working? And when I speak to people, they say, oh, I'm going to be working forever. But a good sort of line in the sand is to say, okay, state pension age is 66 for most people. So I'm going to go 66 here. And that's sort of the length of time I have that I'm still working. And then how long will you not be working? Because you'll want to live and enjoy yourself for that time. And let's say it's another 20 years, which takes you to 86, which is here. So what that means is you've got this length of time to get things in order so that you can live and enjoy your life for that length of time. So how long do you think you'll be paying yourself? So say 20 years or whatever's right for you. And then think about those numbers that I just showed you. Think how much do you need to cover the lifestyle that you want? Then multiply those together. Say if it's £50,000 for 20 years, that's £1 million. And then subtract what you've already got saved. And then that's what you're aiming for in terms of a pot that you want to build. A couple of hints here. The number will be scary, it always is, but you've got time and you've got tax relief that really can give you a big hand. And I'll talk more about tax relief in a minute. Also, remember inflation. As I was talking about in response to Erica's question, yeah, that number will get bigger and bigger, but don't despair about that. You need to, that's why you need to save and invest. And also we have a pensions calculator that can help with this. Hi, Erica.
I've got a question here for you submitted. Thank you to the people who have submitted questions in advance, but also if anybody does have questions, you can go ahead and put them into the chat. Question here from somebody, is the total recommended pension contribution percentage made up of what you and your employer contribute, or just what you contribute?
When I'm talking about saving for retirement or putting money into a pot, yeah, a pension pot is great and you get tax relief and you and your employer contribute. So I'm talking about all that together, but you can save into other things as well. For instance, ISAs are also very sort of nicely tax sheltered and sort of they're quarantined from tax, but you don't get the tax relief. I'll talk about that in a minute, but yeah, do bear in mind if you're an employee, your employer is duty bound to put money into a pension.
And then second question here for you, Lisa, if that's okay. Somebody says, I'm 22 years old. I love that somebody young is here and taking in all of this into consideration. And I'm currently contributing 11% into my pension. Do I need to increase this percentage as I get older, or do I need to just keep it at 11% until I retire?
To the 22-year-old, that's great that you're thinking about these things now. Yes, 11, I mean, I can't be too individual, but 11% is a good number if you're starting this young for the rest of your career. If you were starting later, it would be a higher percentage.
Got it. Thank you so much, Lisa.
Can I have the next slide, please? Okay, so just talking about pension pots there, I mean, the two biggest ones are ISAs and pensions. People often ask, which is right for me? An ISA is very flexible. It's completely sort of quarantined from tax, not inheritance tax, but income tax and capital gains tax. So it just grows and it does its thing. You don't have to worry about it. You don't have to put on a tax return, nothing. And then at the end, your money's there. You can take it. Except for the lifetime ISA, you can take it whenever you want it. Pensions also have the benefit of being sort of quarantined from tax while they're in the pension, and you get a big tax benefit of tax relief when you add in. Then it grows. They're usually inheritance tax free, but there is some tax when you withdraw. They're sort of the first 25% is tax free. It used to be just 25%, but now there's sort of a cash limit of that, which is based on lifetime allowance. But for broadly speaking, 25%, but there's a bit of a caveat there. After that, it's taxed as income. It's just added to your other income and taxed as that. So if you're a basic rate taxpayer, 20%, if it puts you into the higher rate, you'd pay 40%. For good or for bad, you can't access your pension until you're at least 55. And for most people, it's going to be 56, 57, or 58. Roughly speaking, the intention is to have it 10 years before the state pension age. So you can't get at it. If you really need it, that's bad. But on the other hand, it means you're not tempted to dip into it. Next slide, please. Okay, tax relief. It'll be really helpful to explain how it works. Essentially, if you make a contribution sort of out of your pocket, out of your bank account into a personal pension, like a self-invested personal pension or other personal pension, you pay in, say, £800, and then your the pension company goes and gets the basic rate of tax relief from His Majesty's Revenue and Customs and adds it into the pension. So you get like a free £200 in your pension. if you're a higher rate taxpayer, at the end of the tax year, when you do your tax return, you tell the revenue that you have made this contribution and you get another £200. That doesn't go into the pension. That's just less tax that you pay. And then for higher rate taxpayers, it's just that little extra 5% that they get back. One thing I want to make clear is this is if you're making the contribution from your own money. If you're paying via your employer, via payroll, what happens is this all kind of happens automatically, in that it's money that's taken effectively out of your salary before it's even given to you. So you don't have to pay any tax on it. And instead of being given to you, it's given to the pension fund on your behalf. And so you don't have to worry about claiming tax back. It's all done automatically via payroll. And if you've heard about salary sacrifice, that relates to that as well. You don't have to do extra. And it can be useful in terms of bringing down your income below certain thresholds.
Hi, Lisa, me again. Sorry, just a couple of great questions filtering in here, relevant questions here. One question here from a participant: can you take the pension at 55 if you're still working?
Yeah, but you pay a ton of tax, basically, because you're still working and earning income. And what you take out of a pension is just added to the rest of your income. So if you're working and you've got income, I wouldn't, I would really think very hard before taking money out of the pension.
So it's a similar kind of question. With a 25% tax-free pension spread withdrawal, can I take it slowly, i.e. from age 55 to 65?
Yeah, you can. Pensions used to be much more monolithic than they are now. They're much more flexible, and it always depends on your provider, but there's no sort of government rule. You can take as much of your pension or your tax-free cash as you like over time.
Final question here before I let you continue on. Can the tax relief automatically be reinvested into the pension?
The first 20% is automatically reinvested into the pension. If you're making a personal contribution, you'd have to set that up yourself. Of course, if it's going via payroll, it all just goes into the pension and It's all invested.
And we don't have to worry about it, right? Yeah. Thank you so much, Lisa.
Okay. Can I have the next slide, please? Okay, so I said I'd talk about different types of pensions. I'm going to talk about the main ones. Sort of the blue ones there are sort of fixed in inverted commas, because they will tend to go up with inflation. But what you're getting with those pensions is a defined amount of income per year going up with inflation for the rest of your life. The state pension I'll talk about in a little more detail later, but essentially at the moment it's 10,600. It goes up with inflation. Final salary schemes and career average schemes, you get a right to a set amount of income when you retire. Often there are rules about when you can retire with the pension scheme, but those are great and really hard to come by, not in the private sector. They still are fairly common in the public sector. And then the yellow ones are pensions where you contribute to and you get tax relief, and you invest, and hopefully they'll grow over time. But basically, it's not fixed what you will get. You'll take whatever's in that pension at that time and buy an income or take an income as you need it. And those are self-invested personal pensions, which is the one Charles Stanley has available. There are other personal pensions available through insurance schemes. And I think Rob might be talking about the difference between the two in terms of what you can invest. Auto-enrollment is an employer pension that you get if you're employed. And then there's a stakeholder, which was it's a type of personal pension with controls over what they can cost per year. But essentially, think of the two as sort of like fixed, and then there's investment, and then you decide later what's going to happen. Next one, please. Okay, so there's the defined benefit scheme. You're all going to get these slides, and I don't want to take up too much time, but essentially you don't bear any investment risk. That's by your employer, and what you're earning is a promise of future income through the pension, and you contributing and they're contributing. But what you get is not dependent on what you're putting in. It's their promise, which is really valuable. And the defined contribution scheme, where you and your employer both pay into the pension scheme, it's invested, but you bear the investment risk for good or for bad. Because they could, pensions can do very well, and also they can not do so well. You can convert it when you retire into a guaranteed income, which is called an annuity, or it can remain invested and you take as and when you want, regular or ad hoc withdrawals. Broadly speaking, they're not included in your estate for inheritance tax purposes. So sort of when you come to take it off and talk to people who are taking money out of their ISAs and their other investments first and leaving their pensions for later in the hope they're going to be inherited by their children or whoever in a tax effective way. Can I have the next slide, please? Okay. The pension rules, I've picked out the main ones and I'm trying to explain them in sort of straightforward language. With pensions, you get tax relief up to your salary and bonus, your earned income, which is broadly speaking, your salary and your bonus in this tax year. There's another limit on that, which is up to £60,000 a year, and you can carry forward unused allowance. But always the lid, the top amount that you can get tax relief on, is your earned income, your salary and bonus in this tax year. You get tax relief at source for the basic rate. That's the pension company going off and getting the 20% for you. The rest must be claimed by you unless you're doing it via payroll. The money is invested in shares, bonds, and funds in a personal pension. You can choose, and Rob's going to be talking about that. No tax in the pension, no access until you're 55 plus. And then what I mentioned about the first 25% is tax-free, subject to a limit based on the old lifetime allowance, and then it's taxed as income. Next slide,
Got a couple questions here for you, Lisa, if that's okay.
Yeah.
Question here from a viewer: do SIPs have the same limit on being taxed after the first 25%?
Yeah, SIPs. I mean, SIPs are just enough. Think of SIP as just any other type of pension. So it stands for self-invested personal pension, and the difference in a SIP is the flexibility in what you can invest in, rather than any of the tax rules.
Another question for you here. With a defined contribution scheme, is an annuity a way of reducing tax, or when does tax apply? When you take money from the scheme or when the annuity pays you each year?
An annuity doesn't help you with tax. It's the same. The first 25% is tax-free, and then the annuity income is just regarded as other income and is added to the rest. Tax is payable. Tax becomes a thing when you start taking money out of the pension. But up until then, it's not a thing.
It's sheltered, right? It's protected.
Yeah. Yeah.
Final question for you here, Lisa, and then I'm going to let you continue on. Am I understanding correctly, any savings in my SIP can be inherited by my son tax-free?
Not entirely tax-free.
Yeah.
Free of inheritance tax, but if you die after you're 75, then they're regarded as a sort of kind of a quasi-pension of your child, and they are regarded, as he takes income out, it's regarded as his income.
Interesting. Okay, thank you so much, Lisa.
Okay. Okay, state pensions, very much a hot topic at the moment. This year, 10,600. It's great. It rises with inflation. It's called the triple lock. It rises with the higher of average earnings inflation of 2%, whichever is highest, and that's why it jumped to 10,600 this year. You need around 35 years of contributions to get the full state pension. If you were contracted out, you may need a few more. And you need a minimum of 10 years to get anything. You claim it at the state pension age, which is now between 65 and 68. It may increase in the future. You can defer and get a higher pension. You can also buy extra years. People say to me, I already have 35 years. Do I need to keep contributing if I'm working? They're not voluntary. You have to pay. I've put there unless they are, because there's a different sort of national insurance contribution, which is voluntary for this if you're not working. But essentially, you don't get to choose. It's a tax, effectively, that you're paying. And I strongly recommend that everybody checks their state pension age and their contribution rate record at gov.uk. The limit for which buying extra years has just been extended, I think, to April 2025. So there's more time. So it was a bit of a rush before. But I really recommend that you do that. Go online, gov.uk, and you get a wealth of information about where you're going in terms of that.
Me again. Sorry,
Hello.
Lisa. So many great questions coming in, and all of them are very relevant. So I just have to jump in when I can. Can a pension be allocated to a spouse or family member if the pensioner dies?
Yes, I mean, it depends. Are we talking state pension here? No. If you're talking about a SIP or a personal pension, yeah, I strongly recommend it's your money, and you need to tell the pension company what you want to have to that with unused money that's left over in the pension. Defined benefits, so final salary pensions, often have a benefit for a spouse of 50% or 2/3. It varies. But you can't really, it doesn't really go further than that, and there's not a lot of flexibility. Make sure your pension company knows who you want to benefit on your death.
Can those who retire abroad still claim state pension?
I believe so, but there's they get less, broadly speaking. It's complicated.
Yeah.
Yeah.
And then final question for you here, and I'm going to disappear again. Do the 35 years of contributions need to be continuous?
No. They don't.
Great, thank you so
much. The next one, please. Okay, so I'm not going to spend a lot of time on this one, but you have fixed sources of income, the state pensions, salary-based pensions, and annuities, annuities are, you take your pension fund, you go to insurance company, you give them a pension fund, they will pay you an agreed income for the rest of your life. And then there are variable sources of income. So clearly pensions, which we've been talking about. And there's also sort of natural income, which comes from investments like dividends and interest. And then there are things like ISAs, investment bonds, general accounts, savings accounts. Most people, we've learned through our research, top up their pensions with other forms of saving. And the next one, please. I spoke about annuities. Just to give you an idea, I looked at annuities for a 65-year-old person who's in good health. And if you buy a level annuity, so that doesn't increase with inflation at all, and say you had £100,000, you would get £7,175 from that. But if you wanted to link it to inflation, it's quite expensive, and that would fall to 4,513. So you can use that as a percentage at 7.1% and 4.5%. And I've got some examples there about spousal benefits, etc. But I think I don't want to go into too much detail there. What I will say about annuities, they get better the older you are, the better the rate that you'll get. And also, if you're not in good health, and it can be quite minor things, relatively minor things, you actually get dramatically better rates as well. So it's worth looking into. So often people sort of retire flexibly using their pensions on a more ad hoc basis until they get older. And then at that point, they annuitize because things are harder, it's harder to organize, and it's just easy to annuitize. Then, of course, their beneficiaries don't get anything.
Question here, Elisa. What's the difference between the 35 years contribution versus the minimum 10 years? Do you get the same amount?
No. To get the full 10,600, you need to have around 35 years of contributions, of national insurance contributions. And that will go down proportionately if you have less than that. If you have less than 10 years, you get absolutely nothing.
Got it. Got it. Thank you. Thank you.
So I think my last slide is a bit of a to-do list to help you, some homework if you like. So firstly, work out what you have. Many of us have got old pensions that we've left behind as we've moved jobs. Track them down and decide what you want to do with them. Check your state pension, go to gov.uk and look, and consider your other savings and investments. Work out what you're aiming for. I've given you some numbers that, so that you can do that. And we have a pension calculator to help with that. If you're employed, we really don't encourage people to opt out. It's good to be in your employer pension scheme. Find out if they will match extra contributions that you make. Sometimes if you put in an extra 2%, they'll put in an extra 2%, which can be a real win. Try to understand how your pension is invested and think about that after what you've heard Rob has to say. Essentially, it's people often say, oh, I don't have any investments. If they have a pension, they do, because those are invested in things. And if you want to find out more about what this means for you, please feel free to contact me. That's my email address, lisa.kaplan@charles-stanley.co.uk. And I'm going to leave it there.
Thank you so much, Lisa. I do see the questions rolling and we will have time to get to those in the Q&A portion, so fear not, guys. It's now time to hear from our second expert. We've got Rob Morgan on deck here. Rob is a chief analyst and spokesperson for CSD. He's also a very familiar face to the CSD world. With over 20 years experience in financial services, Rob has worked as a financial advisor, a pension specialist, as well as an investment analyst. And he currently specializes in researching actively managed funds, and he regularly writes about investments, markets, and personal finance. He's a real finance guru, if I do say so myself. Rob, the floor is yours.
Thank you so much for that, Erica. Thanks for the introduction. Good afternoon, everybody joining the webinar today. So I'm just going to talk through some of the basics about investing for retirement. Lisa's told you about the sort of more the nuts and bolts and the rules of the stuff. I'm going to start talking about the investment side, and obviously investing in retirement does tend to be for the longer term. That's especially the case if you start early on in life. It's not necessarily easy though, unlike saving. If we go to the next slide, please, Laura. Your money can go down in value, but over the longer term, those fluctuations of the markets tend to fade away in importance on a day-to-day, week-to-week basis, and makes investing over a multi-decade horizon of time that most people have until their retirement a more appropriate thing to do than squirrel away money in cash. You can hopefully try and grow your money ahead of inflation. And if you're unlucky and hit a short-term peak when you're putting the money to work, tend to do okay in the long run as long as you have enough time to recover, and you keep going and you keep averaging in at lower prices, as I'll go on to show you. And on the next slide, really got an illustration there of how insidious inflation can be to the value of money. And this slide shows how cash in the bank or building society rises in the value there. That's the blue line. And rates have become a lot higher recently, which has been some recompense for savers. But if you adjust them for inflation and look at the spending power of that cash, it goes down. And I don't need to tell you what's been happening out there recently within shopping trolleys and shopping baskets and all sorts of other things. That spending power has gone backwards in a big way. So moving on to the next slide. What are we trying to do when we're putting money to work in investing? Well, hopefully it's working harder for you than it is in cash, but it is a balancing act. So if you take too little risk and your capital might not grow as much as you need it to over the longer term, and it won't necessarily beat inflation. And so if you have too much in sort of low risk assets and things in your 20s and 30s, that would seem a kind of wasted opportunity. However, if you take too much risk, then you could end up being a victim of market volatility at the wrong moment. And that's particularly relevant for people looking to cash in or draw upon their investments in the shorter term, so less than 5 years, we would definitely say there. If you're young and you've got a long way to retirement, that roller coaster journey of the stock market, generally that's more okay for you. And if you're older, taking the money out, it's what I call the lazy river, the more serene glide that strips out volatility is probably what you're looking for. So those balancing assets to temper stock market volatility, notably bonds. There was a question on bonds that I saw pop up in the chat. They could still lose money. They're very sensitive to inflation and interest rates, so that's why they did very badly last year. But they can, in a lot of circumstances, be a balancing asset, and probably going forward, actually from here, from this point onwards, they probably will be in a lot of circumstances a balancing asset to equities and or shares. Now, what you'll find in a workplace pension scheme is you've got what's called a default fund, and that tends to be a mixture of assets. Now, the typical combination is about sort of 80% equities and 20% bonds, and that's a kind of one size fits all, a bit of a compromise. So you don't make an active decision. That's probably where you'll end up, and that sort of investment will, hopefully do a decent enough job for you over the longer term, especially if the charges are nice and low on that scheme. One other thing I would flag up when you're looking at your pensions is something called lifestyling. So if you're a little bit older and closer to retirement, this is a process that traditionally applies to some older personal defined contribution work pensions and things like that. And it's a process that moves you from mostly shares where you're invested to mostly bonds, typically in those years before your nominated retirement date. And the idea is that you actually move from the roller coaster to the lazy river over those 5 years before you start drawing on the pension. And those are designed really to lock in on the cost of buying an annuity, that guaranteed income that Lisa mentioned, by migrating to bonds and gilts or UK government bonds within the fund. But lots of people don't buy an annuity, so it might not be appropriate for those people. Keeping your money, if you're keeping your money invested and drawing lump sums as and when, perhaps further down the line, you might not want to be in lifestyling. So do look out for that, and have a look at your pension statement as to where you're invested. So at this point, worth recapping on the differences between holding individual shares and funds. So if you move to the next slide, please. A share is a share in a business, and a fund is basically a way of diversifying or spreading your money across lots of different businesses if that fund is investing in shares. So rather than holding one company, which would be very risky, you spread your investment around. They're either managed by a professional fund manager in case of an active fund, or designed to track a particular index in the case of a passive fund or tracker fund. And a global tracker, that might be a good basic option when you're not able to spend much time researching investments. They tend to provide simple and low cost exposure to share markets around the world. And obviously it's very difficult for people to be a fund manager and monitor a portfolio of their own investments and shares, but keeping tabs on a fund or a few funds is much easier. And as I mentioned, you'll have a default fund if you're in a workplace scheme, which is a standard fund if you end up in, if you don't make an active choice. So a bit of a one size fits all, as I mentioned. And you can always override that if you want to make your own investment decisions. And a lot of people do like to do that, but if you move into something that's higher risk, then you're going to get those greater ups and downs as a result of that. If you went into sort of 100% equities or shares or something like that. So your choice of investment is going to be dictated by the type of pension you have. So on the next slide, I've got a list here of those differences. Whether you have a personal pension or a similar vehicle, perhaps a group personal pension that you've had through work, or it's something a bit more flexible like a SIP, a self-invested personal pension. And that tends to have a lot more investment options, especially for those who want to be really hands-on with your investment choices. So a standard personal pension or defined contribution scheme will tend to have a range of funds, albeit a relatively limited number, depends on the scheme. You might find those charges pretty good on that if it's a really broad, wide scheme and it's been set up relatively recently in particular. SIPs, meanwhile, are much broader. You'll be able to hold a very wide range of funds, several thousand, for instance, in the Charles Stanley Direct SIP, as well as ETFs, so exchange traded funds, investment trusts, individual shares, both UK and overseas. So lots more options that you can explore to tailor a portfolio if you want to do that. And this would apply to ISAs as well. So Lisa mentioned those as a source of income in retirement also, and that will be, you know, similarly wide in terms of the investment universe that's possible there. So either way, it's possible to build a portfolio that suits your objectives and the risk level you're happy with.
Hi, Rob. Sorry, just quick question for you here, which is relevant. Are fund management fees always a percentage? And do you have advice on how to diversify well, for example, geography or industry?
Yeah, so they will be always expressed as a percentage, and there'll be a function of, you know, the type of the fund and the you know, whether it's active or passive, and the area of specialism as well. So you have higher fees for things that are more specialist. It's always expressed as a percentage. You will find that, you know, maybe much bigger funds have some economies of scale, so their charges will be a bit lower. So the other question was on sort of diversification, and, you know, some good ways to think about that. I mentioned a sort of global tracker earlier. That gives you, you know, some good diversification across lots of companies. But if you want to look at asset classes as well, then, you know, a sort of multi-asset fund would be, we have our own range at Charles Stanley, for instance, is a really good way of covering lots of different bases. And what you can do with those is kind of tune it for the level of risk you're happy with. So you can kind of set the level that's invested in the stock market, which is going to be the most volatile of the elements of that portfolio, and the rest of it will, you know, be diversification and balancing assets in the long run. So you know, they're a really good means of actually spreading your risk around.
If people are interested to learn more about funds, also, we have started a new video series called Fundamentals, where we are learning from fund experts and people like Rob about different fund areas to encourage people to learn more about them. So if anybody does want to check those out, we'll send that in the corresponding email. Final question for you here, Rob, not disappear. Are mutual funds the same thing as ETFs?
Yes, and I think mutual fund is a more of a US term, but so we would call them unit trusts and OEICs, but they are also known as mutual funds. Not quite the same thing as, sorry, was it an ETF?
ETF.
Exchange traded, yeah, exchange traded fund is, it's the same principle. It's an open-ended fund, but the exchange traded fund will be listed on and traded on the stock market. So you can actually buy in real time when the shares are trading, whereas a mutual fund, OEIC, unit trust, there's a daily price for that, so you have a different process for dealing.
Great,
that's
thank
the
you so
major
much.
difference. Yeah,
cool. Thanks.
The other thing I'd add to that is ETFs are almost always passive investments, whereas funds can be either active or passively managed. So if you go to the next slide, I'm just going to talk very briefly about sort of compounding, the things that you have really on your side when you're investing for retirement. So, you know, your choice of pension funds, that's going to be really important, but the most important thing really is taking action and getting going. And the earlier you do that, the better, because time is really your friend. I've just got a really simple example of that. If you're able to start early, it makes a huge difference. So to illustrate that point, I've got an example here of two investors, both investing for retirement in 40 years time. The one on the left starts investing £100 a month right away, and the other does nothing for 20 years, but then invests £300 a month. So the investments both grow by 5% a year after charges, to keep things simple there. And at retirement, the first investor's got would have spent, £48,000 on their monthly contribution. And the second investor, who started later with a higher amount, £72,000. But despite having spent less money, the first investor's retirement pot is going to be worth 150,000, but compared with the second investor's 120,000. So if you start early as you can and you persist for as long as you can, that's a really great recipe for building the retirement pot you need. So regular investing, really powerful as well in terms of ironing out the volatility. If we move to the next slide, please. So in this example, I've shown £100 invested each month for 10 years into a tracker fund, aiming to follow the performance of the FTSE 100 index. Now, a tracker fund, you're going to be investing in the UK stock market in this case, and as this market moves up and down, you'll be investing in at different levels at different prices, and dips in the market, particularly in the early years, can even work to your advantage. Now, as you can see, there isn't a huge amount of volatility in this chart because you've basically had the effect of consistently adding money at different price levels along the way. And plus, you've actually had the reinvestment of dividends, which is the income from shares that irons that out. Now, if you compare that to the following slide, we just move on with one. That's it. That's the volatility if you've invested a capital sum. So it's much, much greater. And actually, the capital sum is £12,000, which is what you would have spent in your £100 a month contributions over the decade. And it is higher than you would have got from regular investing. But the point here is that your level of volatility is a lot higher when you've got a lump sum compared to regular investing. So that dampening down of the volatility, it's known as pound cost averaging. A great way to get started in investing, turns things in your favor if things go down in the short term. So that can make things less scary, and you can apply that over any time frame. Best works over a long time frame, but very powerful, especially with tax relief on pension contributions that Lisa mentioned as well. So you've got a double boost. Now, finally, in the interest of time, I'll move swiftly on to my final slide, which is on your pension statement. Now, there can be a lot of confusion about them, and there's a tendency to basically not look at them and sort of file them away, or worse. So pension statement is basically an annual summary of your pension pot. It shows you how much you've built up, or gives you a projected retirement income, or it tries to do so. Now, regularly checking your statements can be crucial to ensure you're on track and you're saving enough. So if you're saving into a defined contribution pension, or you saved into one in the past, your pension provider should send you one of these every year, so you'll be able to look at it. And for other pensions, defined benefit schemes, you might not get one every year, but you should from time to time request one to keep up to date with the benefits that you've accrued. And you should also ensure that your pension provider or administrator has your current details as well. Now, defined contributions pension statements contain lots of information, including the amounts you've paid in over the past year by yourself and your employer, if that's applicable, and the pension tax relief that's been added in. And it'll also show you the value at the start and the end of the statement year, so you can see how much your pension has risen or fallen by. If it's fallen, not necessarily any need to worry. That's hopefully just 1 year in the long journey you have in front of you. But if you're closer to retirement, say, and you're looking to take money out of your pension, then that's perhaps more relevant, and you can always look at the fund choice there more closely to consider something that's going to keep volatility more in check. And it should show you on the statement where you're invested as well, the funds you're invested in, and if they are predominantly in share markets, you can obviously expect larger ups and downs. But it does give you an opportunity, an understanding of where your money is and how those investments are performing for you. So you're better placed really to consider whether that's right for you. It also includes a projection of what you might get back at retirement. Now, a lot of assumptions have to be made to produce the figures, so they're only a rough estimate. So your investment returns could be more or less, and you might retire earlier or later than what it says on the statement. But it should be a helpful guide. And some of the figures will also assume that you use the pension fund to buy an annuity, so guaranteed income at retirement rather than a lump sum. and annuity rates will also vary quite a lot due to various factors. But nevertheless, the information's important in helping with your planning, and the figures will help you see if you're on track, and you can plug them into an online tool such as our own pension calculator, which can run different scenarios such as retirement ages and the effect of different additional contributions and things like that. And that's my section over. So I think we'll go straight into Lisa now, who can sum up how she can help people further with their retirement planning.
Thanks, Rob. We've done a lot of talk about sort of general principles. If you want help knowing what all this means for you and how you can plan to get the retirement you want, that's exactly the work that me and my team do. It's a fixed price service. We're offering a special price to people who are watching the webinar of £840. If you're interested, there's a QR code, or you can email me, but it's really talking about what all this means for you in your circumstances and what you need to do, giving you a plan so that you can have the retirement that you want. More details, happy to talk afterwards. And I'll hand over to Erica now.
Thank you very much to all of you. Okay, we're now going to open the floor up to the Q&A session. This is my favorite part of our webinars with our very own in-house experts who you've heard from already. So this is your opportunity to ask them questions. I definitely see we have a couple in the chat already, which is awesome. Okay, you know what? Let me just get started. Somebody says, apologies for jumping the gun. In today's economic state and somebody with a mortgage, would the recommendation be to invest more money into your pension or pay off your mortgage? Is that a Rob question or is that a Lisa question?
I can take it.
Rob.
Lisa might have a view as well, but I mean, yeah, really difficult. Obviously, mortgage costs going through the roof, no pun intended.
Yeah.
Comes down to a number of things. So I would say getting your employer contributions, if that's relevant to you, in the form of your workplace scheme would be a priority, as would perhaps securing higher rate tax relief. Then after that, it comes down to kind of what's right for your own personal resilience in the short term as well. So it's balance between those things. I mean, mathematically, it would probably make sense to try and maximise pension with those elements that I've just mentioned, notwithstanding the fact that there may be particular constraints on people in the short term. Am I about right there, Lisa?
Yeah, I think mortgages, people are really feeling them going up at the moment, and the more you can pay off, obviously the less interest rate you're paying, but you don't want to miss out on those pension benefits that Rob was talking about. It's hard. It is hard, and it's difficult to know what to prioritize.
This is another question of this or that. Somebody says, I'm 26 years old. Should I prioritize saving in my pension more or a stocks and shares ISA? Who wants to take that?
I'll take that one initially. It's what are you saving for? Everyone's going to retire one day, and a pension is about saving for that, and that's important. But accumulating money in a stocks and shares ISA, it's always what is that for? If it's something in the shorter term and you need that flexibility to be able to get it out, like you want to buy a house in the next few years, then that's better. I must caveat that also investment is long term, so 5 years plus. So perhaps if you have a much more shorter term goal, cash is king there.
Yeah, that was definitely a consideration for me when I was thinking about the exact same thing. And a determiner for me was the fact that you cannot touch your pension until you reach 55, but that age is set to rise to 57. So if you don't need the money until that time, all good, all fine. But definitely a personal priority for investing for me is buying a house sometime down the road, probably a lot farther now than it was a year or two ago with mortgage rates, but that's something that I'm personally investing for. Okay, next question here. Do you have any approximate guidelines for how much you should be putting towards pensions for each age group? So like, for example, if between 20 and 30, like it's 10%, what would you be saving for like 40s and 50s?
There's a sort of a rule of thumb that's out there, and it depends on when you start as well. So if you're just starting, roughly speaking, you put in half your age. So the 22-year-old putting in 11% would match that. But if you're starting when you're 40, maybe you need to put in 20%. And, you know, that's a general rule of thumb. But pension calculators work this out exactly. They take this all into account.
Okay, next question here, conscious of time, so I'm just going to try to speed through these. If you're a higher rate taxpayer, does the additional tax relief automatically happen through your employer?
Yeah, if you're paying via payroll, generally it goes before it's paid to you. It goes straight to the pension. Have a look at your pay slips. It should, you know, you can see it there, and also at your the P60 that you get at the end of the year.
If somebody has multiple pensions with different providers, is it a good idea to combine them all into one? In theory.
I'll take that one quickly, not from an investment point of view. Only if the benefit is that it's easier to administer, but that doesn't matter for some people. They're comfortable having 3 or 4. But sort of, if that's a problem for you, you can bring them all together. It's sometimes you get better rates because it's a bigger amount of money that you've got all together. And from my perspective, it's easier to have a sort of a coherent investment strategy across them all if they're all together. Sometimes though, if you move pensions, and especially very old pensions, you could lose some guarantees that you have, like guaranteed amounts of annuity rates or tax-free cash. So it's worth checking that before you put them all together. On
that note, would you be covered if you buy an annuity and the company providing it goes bankrupt?
There is a pension protection scheme, but maybe the person asking that question should email me, because I don't want to talk off the top of my head.
Yeah.
I'll check and get back to them.
Okay, got it. Okay, next question. Is it possible to split your pensions between an annuity and a flexible drawdown, sort of like a hedging of one's bets? Can you split your pension?
Yes.
Rob? Yes, fine, perfect, nice and quick and easy. Next question here. Given how market dynamics have changed with correlations inverting, etc., is it worth considering active or passive funds, all things being equal, e.g. the FTSE?
Oh gosh, that's such an open-ended question, and I'm very conscious of time. Oh gosh, well, if you're in passive funds and it's global, then you're going to be very weighted towards the US. You're going to be very weighted to those famous FANG stocks that everyone knows. So you're corralled into quite a narrow band of companies representing quite a lot of your portfolio. That's one risk to be aware of. And there's other markets that are cheaper, the UK, Japan, etc. That's a risk. Where you come down on the active or passive side is kind of a judgment call. I think you want to probably have the best of both. So best of passive for global markets, wide exposure, and then some good, more specialist investments to take advantage of other opportunities.
That's what we like to call diversification. Question here, can you top up your state pension contributions missing years after, even if you've already retired?
Yes, you can.
And where can people find out more information about that?
Gov.uk is your friend. Also, Martin Lewis has a ton of information about this stuff.
Yep. Okay, next question here. Are pension apps that show all your pension amounts and details a good idea, or do you think they're just an extra expense on top of fund management fees? Do they provide with more stuff than what what, for example, we have with our pension calculators?
To be honest, I'm not really sure. I mean, if it's helpful to you, that's great, and it keeps you on top of your money. That's helpful. But I'm always concerned about things that have a percentage of the amount of money. I might prefer a fixed amount that you know what you're in for. If it's helpful to you, great. If it's not, don't do it.
Question, should you factor in cost of care when thinking about how much you'll need for retirement? Lisa, I know that your one-step modules have that really top of mind.
Yeah, I often talk about sort of the U-shaped retirement. When you first start to retire, yeah, it's great. You're traveling, having fun.
You're on a beach, yeah.
Then later on, you're more of a homebody. You're less active as it's, your age takes its toll, and then sort of in late retirement, your later life years, you're actually spending a lot on care. So that's your costs go up again. Care is enormously expensive. I sort of think about £1,000 a week, and you need to keep some money available to pay for that. I mean, the council will step in if you have nothing left, but really, if you have nothing left.
Okay, I'm conscious of time here. We unfortunately do have to call it here because we cannot run over too much. We're already over a couple of minutes. But I do just want to say thank you so very much to our speakers for sharing your expertise and knowledge with us. And thank you to each and every one of you for taking the time out of your day to drop in on this webinar. This is a medium that we would love to use more and more going forward. We hope that you guys learned something. We hope that your questions were answered, and we hope to see you at webinars upcoming in the future. We do have a list of upcoming webinar topics and when approximately they will be. We'll put that on the screen there. So please do keep your eyes peeled for that and register for those events as well. Also, please do keep out for an email from us shortly too. So we'd love to hear your feedback on today's session. You can hear more about Lisa's great work and what she does with One Step. You can also get the recording and the slides for today. Lots of great stuff. So please do keep your eyes peeled for that. Going to call it now. Thank you all so much again. Lisa and Rob, you guys are absolute stars. Thank you so much, and we'll see you all soon, hopefully. Bye, everyone.